Next guest looking for stocks that can grow their dividends in a higher rate environment, and he is putting money to work in 2 new buys. Joining us now, Post 9's Matt Powers of Powered Advisory Group. Welcome back to Post 9. It's good to see you again.
Yeah, glad to be here.
Well, this is a pertinent conversation given the backup in rates, right? I'm sure you're thinking about this a lot, and if you're looking for dividend growers, the so-called aristocrats are down 5% month to date on fears of backed up rates for a longer period of time. How are you thinking about that?
Yeah, no doubt it's a headwind for dividend growth stocks. I mean, I think we can all agree on that. You know, it doesn't impact our strategy. It does not change how we're investing. I think any dividend growth investor is going to realize it's going to require a lot more patience just moving forward.
Yeah. Do you think it's going to impact performance of money managers or fund managers who are explicitly looking for stocks like this if rates remain higher for a longer period of time than we first thought?
Yeah, absolutely. You know, just from our perspective, our end, when we are in kind of getting this out there, our lean, we focus more on dividend growers, less on high yield. So we're not looking for a bond alternative or a fixed income alternative. We're looking more at growth. So it's total return is what we're after.
Okay, so recent buys, let's highlight a couple of them. MasterCard is one. It offers a, I think what most people would say is a small yield, and not even a 1% dividend, but they have grown their dividend over a period of time, which qualifies them for the kinds of stock you look for. Tell us why this one particularly stands out.
So normally we're looking for a 2% yield on the stocks, but MasterCard's at 0.54%, and it's staggering. Over the past 10 years, they've grown the dividend 27% a year over the past 10 years. So that's anything that is growing at that rate eventually, obviously, is going to catch up. Mm-hmm. So, that's one part. The other part, too, that's kind of missed in this entire equation is the payout ratio. So that's the percentage of earnings that is being paid out in the form of a dividend. MasterCard, 19%, 20% roughly, somewhere in there, which means they've got a lot of space to grow.
Okay. Hershey. 2.6 yield. Why this one?
Cocoa prices. So over the past...
We just showed those on the network within the last hour.
Oh, seriously?
Yeah.
Okay, good.
Yeah.
So over the past year, hopefully I'm quoting this right, is somewhere roughly around it's 250% year over year. So I think a lot of that comes from supply, Africa, some issues with weather, but Hershey is a great dividend payer. Was not on our radar before, but as the price has moved down, I think the price is down about 27% over the past year. Yield has went up, and it hit our radar, and we look for a 10-year track record of dividend growth.
How are you thinking about dividend growers here?
So what's different from your strategy versus buying the dividend aristocrats as kind of like a smart beta factor-driven strategy? What are you doing qualitatively that doesn't get captured in something quantitative like that?
So aristocrats is a 25-year period, and that gets stretched out so long. That's such an extended period. We look at 10-year on the dividend growth side. I mean, that's the simple answer to it.
So you'll pick up on stocks before they become aristocrats?
Correct.
Interesting point. Others that are part of your buys recently, Lockheed, right? Starbucks, McDonald's. You want to talk about any of those?
Sure.
Why they stood out?
Yeah, so Lockheed, purely a geopolitical play. With the tensions in Iran, Israel. It's a long-time holding, one of our original holdings on our books. Loved it ever since. It's got a great dividend growth rate track record. I mean, performance has been great over the past decade, but purely a geopolitical play.
What about McDonald's?
So you can almost, I don't know if it's okay but Starbucks, McDonald's, almost lump them into the same group. They're both kind of kings of the fast food industry. They're both down. Stock price is depressed, year to date, and really not a great reason as to why. So their valuation looks excellent, and they fit that dividend growth rate perfectly.
Are we moving back to a stay big and don't go broad market? So over the last month, or at least month to date, real estate's down 9.5%.
Yep.
Dividend aristocrats down 5%. So do I need to rethink the whole thing right now?
No, because those drawdowns that you're quoting to me are off of new highs in many cases, like not necessarily real estate, but the dividend stocks, for example. You've had new highs in these segments, and these are stocks that have gone up anywhere from 20 to 50% since the bottom in October. So I don't think that a 5 or a 7% pullback is disastrous, and in fact, you would probably expect it to be part of a healthy bull market.
Let me just zero in for another moment on dividends because they're so near and dear to a large swath of our viewing audience, I think. And, we were coming off of a tough year for dividend stocks.
Yeah.
And the narrative coming in was, okay, rates are coming down, so dividends are going to be good. And they're going to have a good comeback.
Yeah.
And now if rates are going to back up, maybe not so much. Maybe those who really spend the time looking for the dividend stocks to get that income are going to have to rethink at least that part of the market.
So, as you know, Jenny Harrington and
I'm thinking of Jenny.
We have a, 7-year blood feud running. I disagree with the premise of let's identify a specific dividend yield and then hope we like the stock that's attached to it. I just don't think the majority of investors are targeting in on a yield and then working backwards. I happen to think the better companies pay dividends, not usually the highest dividends, but the dividends that are most consistently growing from one year to the next. And oftentimes when we're talking about dividends, we're talking about quality, number one, and we're talking about companies that are also, in addition to paying out a dividend yield, doing a decent-sized buyback. That story, I also think, remains intact. We should see $1.2 trillion worth of buyback activity worldwide. It's actually growing overseas faster than the dividend activity is recovering here. You would be understanding, looking at companies in 23 and 22, slowing down with the buybacks and slowing down with the dividend growth. There was a lot of uncertainty, and people just weren't sure how they would fare in a higher interest rate environment. Now we're in one. We've been in one for a while. We kind of know we'll be in one for a while to come, and companies are still looking opportunistically how they can return cash in the most shareholder-friendly fashion. I don't think that theme's going to be extinguished this year.